Welcome to Miami. Yes, we are the smaller than 500 million group. So, as Al mentioned, I'm Dustin Cordier, founder of StepZero Coaching. I help business owners and their leadership teams lead with intention. So that means getting clear on their vision, executing with discipline and accountability, and building something that endures beyond themselves. So I do that through a combination of exit planning, EOS implementation, and sales outsourced services. And one of the things that comes up often when I'm working with my clients as they're trying to build to the next level is how do I get investor ready? And what does that mean? So I have a distinguished panel here with me who have experience with that themselves and are also advising companies on becoming investor ready. So I would like to introduce Richard Emery first. Now, Richard has a long bio, lots of accomplishments in the industry. It's a longer list than a 7-year-old's Christmas list, so I'm just going to hit the highlights here on Richard. Richard's been a leader and manager in aerospace companies for over 30 years, worked at the OEMs, completion centers, MRO, and service providers. He also served as the CEO of OSS, a firearms suppressor company. Go America. And he worked with a placement firm with Mavin Capital Partners. He's now managing director with Aurum Capital Connect. And Richard's also a UT, University of Texas grad, and we have a UGA grad on board, so if they start fighting here, give us a little break there. So Richard was a board of director at Scandia Corporation, and he's also involved with fundraising for the Jesuit College Prep of Dallas and on the Salesmanship Club of Dallas. They put on the Byron Nelson tournament there and does a lot of work for a nonprofit school center for high-risk, low-income children and families. Richard, thank you for joining us.
Thank you for having me.
Danny Gizzi here is well known as the CEO and founder of Aircraft Executives, a IATA certified aircraft brokerage company going on its 10th year, correct? Yep. What many in the room may not know is the depth of financial background that Danny has, including capital raises and startups. So Danny, give us a little bit of background on that side of your experience for us.
Sure. Have a background in startups, so three different aviation startups. So one of them was a kind of a software and an operational company that we did a whole bunch of seed funding, and we also did a Reg CF crowdfunding and some NFT stuff with. And also outside of aviation, was also CFO of another company that we acquired through mom and pop kind of acquisition stuff. And back to the connector thing, a couple acquisition roll-up attempts as well.
Great. Thank you, Danny, for joining us.
Thank you.
All right, if I have a slide here. Oh, it's going up front, but it's not going on the in front of me. Okay. So we had a Slido question that I don't think is showing, but the question here, and if anybody wants to answer it directly, is how can a business that has $5 million in EBITDA on an annual basis be unsaleable? Unsaleable is unsellable. Nobody wants to buy it, yet it's throwing off $5 million a year. Nobody wants to answer that one. So the fact of the matter is, Richard and Danny and I, we see that all the time. And there's a lot of factors that go into it. It can be an owner is unreasonable. There we go. There's our Slido. It could be the books were a mess. It could be that their customer concentration is highly concentrated in a single customer. There is a variety of reasons, and the statistics are actually alarming. So 80% of businesses are unsaleable, and of those that sell, 75% of their owners regret selling. So what does that mean? If there are 100 business owners in this room right now, looking to exit through a sale, 5 of you, 5 of the 100 are going to walk away happy. So we're here to help you be one of those 5. Actually, we're here to help grow that 5 into a much higher number. And the fact of the matter is very few people who start a business start it with the intention of selling it. They start it because they have a good idea, and in aviation, it's often tied into a love of blue sky that goes with it. But the fact remains that Act 3 is coming for every one of us in this room. If you're a business owner, if you're on a leadership team, at some point we will have to hang up the cleats and move on to the next level. And so in order to have that option, in order to have an option to sell, your business, the business owner must be intentional about becoming 2 specific things. The business must be both attractive and it must be ready. You must have both. So what does that mean to be attractive? Good question. There we go. Now my panel's working, but the background's not. Okay. All right. So when we're talking attractive, it's really similar to what Sean and Jim were saying before. This all comes down to a risk and reward curve. I mean, why does anybody invest in anything? So if we take a look, nothing on the screen there is unusual. When we're getting into the private investors, we are at a higher risk, and so they're going to want a higher return. And if we look at this curve in a little bit more accurate way, what we see in this slide is really just the mean of the curve. This is when we're at the mean, but what these really are when an investor is looking to invest is the higher risk means the higher variability. And so Jim actually said this himself, even in the $500 million to $1 billion sector, what does the investor want? The investor wants a certainty of growth potential and predictable cash flow. That is what they're looking for, and that is what makes your business attractive. Richard, any thoughts on that?
No, I mean, you know, it's really not rocket science, right? I mean, predictable cash flow is great. Growth potential is great. Doing that through stickiness like contracts is something that we see investors look at all the time. So, you know, it's almost a requirement in today's environment.
Yeah, and Danny, being a person that's running his own business right now, that's in the thick of it, why is it so hard for a business owner to concentrate on that aspect of making the business attractive?
Well, most people who start their own businesses like myself, it's all about like passion and what they're looking, what brings them joy and what they want to do. And they never started the business with the intention of selling it. So being attractive is having all the systems in places, the financials are in order, you're prepared for an exit at some point, and most people are not, being a business owner.
Absolutely. I mean, it's so difficult to separate yourself, to pull yourself out of the business because your blood, sweat, and tears are so busy being put to use inside the business. The second component of that attractiveness is readiness. And readiness has to do with putting the house in order. So Richard, what are some of the components of putting the house in order? Even if you're throwing off good cash and it's predictable, there's a clear growth trajectory, what else needs to be in order?
Well, you know, I think one of the major things that investors are looking for certainly has to do with financials. You know, it makes such a huge difference if you've got a really good CFO or a really good controller in your organization, your financials are audited. You know, that can be a real sticking point when you get into deal mode. So, you know, having your financials in order, making sure that you've got your your bench strength there, making sure that you've got sustainable processes, repeatable processes, that sort of thing, all makes a very big difference. I will say this, I think one of the top things that people look at are the management team, the CEO, and the succession planning and leadership in a company. You know, ultimately a business is the sum of its people, and people make the business. And so when investors are looking at your companies, they are looking at that in great detail to see if that's something there that's worth investing in.
Excellent. Danny, what is involved in the due diligence period in the process? So Jim had talked about it was only 4 to 6 months for the Flex deal. Typically it's 12 to 18 months on a full sale. What goes into that?
Well, it's, using the startup mentality of raising funds at the beginning versus, the exit so much at the back. But when you get a seed run going, you sit down with your attorneys and you come up with the valuations and your forecasting, and there's a lot of prep work to get the data room ready and the deck and how much you're going to go ask for and the valuation. And that's a lot of work just to get started. And then once you have that rolling, then it's the roadshow of the constant, meeting with venture capitalists and accredited investors, and it's a constant. So if you don't have your house in order, as you say, you're not running a business. Your entire leadership team is being interviewed nonstop, and you're being bogged down, and no one's really running a business, and it can really hurt you because it's a lot of work and it's a lot of time where you're answering a bunch of questions, you're entertaining the venture capitalists, the firms, and you're trying to, get your anchor investor. And then if you spend too much time with the wrong anchor investor, then you didn't get the funds that you were looking for. And then the whole round has gone to upside down of what you were planning on.
Very, very involved. So, Richard, you and I sometimes get clients that say, hey, I would like either to exit or to take some chips off the table, and I'd like to do it in the next 6 months, right? And so if that's even possible, how do they get ahead on the due diligence? What can a company do so that their data room, so to speak, and everything that goes into it is at least ahead of the game?
Selfishly, and I think Jim would probably agree with this, would be to hire somebody to help you do it. That's fundamentally what we do, right? And so part of the service that we provide is business sale process. And there's a process. And depending on how organized you are, what kind of staffing you have, that sort of thing, that can be, a longer process. And, just preparing the financials, going back through the tax returns, doing the legal work that you need to have, making sure you've got clean organizational structure, your operations, there is a list of things that if you really want to have a very successful transaction, you can have them kind of ad hoc, but if you want to have a successful transaction, following this process, getting that in order, which takes time, because as you said, Danny, that you're trying to run a business too, right? And that, by the way, is something we see a lot. Folks get called, they decide to go into the process, they spend 12, 14, 16 months working on a process, the process doesn't happen. They've taken 14, 16 months, they've taken their eye off the business has kind of gone backwards a little bit, so now you got to go and get the business back to where it is. So, I think it's just really incumbent, if you can do it, to make sure that you've got a good team of advisors around you helping you with the process.
So let's just stay with that. So the advisor, where does Aurum Capital Connect kind of fit in the ecosystem?
I mean, we're a lower middle market investment bank. So we connect founders and owners who are trying to either sell their business, raise capital, or find other businesses to buy with capital sources to help them go do that, or with potential buyers of their company. So, you know, it's a licensed group of people that have done this for a living. Some of us, you know, have financial backgrounds. Folks like me have more operational than financial background. And, you know, we like to help founders get to a result that they're looking for.
Yeah, so we were talking before, all of us have stories where the purchaser kind of pulls the rug out from underneath the seller at the 11th hour. So, you know, trying to do that without an advisor, how does the game work, Danny? Explain the tricks of the game there. What's actually going on?
Well, yeah, so when you, for example, that seed round that I was referencing earlier, you get, you know, you're looking for that anchor investor, who's going to be the lead. And when someone comes in, you know, venture capital, private equity, they want to get you to the table. They will tell you what you need to hear to get you there. And then they will promise you to be the anchor investor. And as I said, they keep you distracted, trying to, you know, going through the data room, going through the financials, weekly calls, spending the week to, you know, to prepare for these weekly calls, them coming to town, go to see this headquarters of that operation, and, you know, and then you spend, like you're saying, like, you know, almost 10 to 12 months for this one round where they promise, you know, let's, easy numbers, $1 million of a $2 million raise, and it comes time to sign on the dotted line, and it's, oh, we're going to do 150 this round. Our budget's changed for investments this month, and or this quarter, or whatever it is, and that's detrimental.
Yeah, so Richard, one of the things we talked about, and that your firm actually is one of the cornerstones, is coming with reasonable expectations to that table. So Danny mentioned that the buyers they're preying on your happy ears, right? They're telling you what you want to hear to get you to the table. How do you know, how does a company know what they're actually worth? And how do you guys help them determine that?
Well, I mean, obviously, you know, financially, you know, one thing you want to do is go have a valuation done on your business. And depending on the scale and scope of your business, you may want to do that annually or every couple of years, just so you have it fresh in case the phone call does happen. But, you know, there's different ways to figure out a value of a business. I mean, you know, you can do your discounted cash flows, and you can do comps, and you can do ratios, and you can do all this stuff. You also have you're in the market, so you're seeing it. But, you know, the thing that we try to do is really sit down and make sure that the founders' expectations and goals are aligned with the market. Because if they aren't, there's going to be disappointment there at some point. And you can imagine folks who thought about going to market prior to the interest rates rising dramatically in the last administration. They were getting numbers thrown at them that were significantly different than when they actually decided, okay, now I'm ready to go in this high interest rate environment, and the numbers had changed dramatically. So unrealistic expectations will kill a deal almost 100% of the time.
So, and I just switched to the slide of basically the business valuation basics. And what's interesting in this slide is, yes, the financials are hugely important, but the financials, whether it's an EBITDA or a sales number, are typically multiplied by a multiple. And so in the aerospace community, difficult to come up with a specific multiple for a company, but if we were going to generalize, we're looking in mid to high single digits is fair to say. If we're talking a best-in-class company in the aerospace environment, what kind of multiple would be considered reasonable? It's not going to be 30, probably not going to be 15.
I mean, and then I'll let you answer that question. That's a really hard question to answer because there's so many variables in a transaction. And so it's a tough, that's a really tough question to answer. You know, you know, a lot of people still have the tech multiples in their mind, right? The recurring revenue kind of multiples in their mind. But, you know, depending on the business, depending on what it is, you know, probably high single digits for a number of sectors is realistic.
Yeah, I agree. It's not the tech bubble kind of at multiples, but definitely in the singles is what it seems that we're seeing out there. I think the last panel hit on that a little bit more, but every business is a different transaction. Two charter companies aren't the same. There's different enterprise values for each one.
Right, right. And so both of them walked into my trap. So no, they didn't walk into my trap. But I think if you look at this equation a little bit closer here and you see what's under the intangible capital is up to 80% of the worth of your business. So if you're a business owner right now, chances are you're thinking about sales and hitting the quarterly numbers, et cetera, but almost 80% or more of your company's worth is in these intangibles, and these determine your multiple. So Richard said it before, it's your people. What's your bench strength? What's your leadership of your team look like right now? What's the structure of your business in terms of the processes? Do you have processes for the core aspects of the business? Are you taking the most important parts of your business and doing them the right way and the best way the first time and every time? Your customer capital. Do you have a widely diversified customer base? Are you selling to a single entity that if they pull the plug, it's going to be a serious dent on your revenues? And finally, the social capital. Is there a palpable culture within your organization? And has that been recognized by a third party? Are you a top 10, top 100 place to work, et cetera? Have you been deemed a top employer of a certain region? So all of these factors become the majority of the value of your business, the majority of the value of your business. And so from an owner's perspective, that's a massive shift in thinking. Because an owner is not necessarily an operator. An operator spends all their time working in the business, trying to figure out how to make the business more efficient. The owner has a mindset around these intangible capitals. How do I make this an attractive place to work? How do I build a palpable culture that people want to be part of? How do I help people become their best so that I get a great leadership team and have a great bench? And yes, there is an aspect of diversified customer base in that, and that's a strategic over-the-horizon look, and that's where the owner separates themselves from other owners by removing themselves from operation, looking at the business from above as if they were an investor, and working on the business, building something that's going to grow the enterprise value of the business as opposed to just hitting the numbers on the sales. And yes, that's important, right? And the customer experience is critically important, but those intangibles are going to be where the majority of the value of the business lay. So, Richard, you gave us a little bit of a glimpse of the process, but walk us through just a typical transaction. What's all involved in using an investment banker, right? What is an investment banker? Why would you use them, and how does that process kind of roll out?
So, you know, investment banker traditionally connects opportunity to capital, and that's a sell-side opportunity, which is you want to sell your business. It's a buy-side opportunity, which is you want to go out and find other businesses to buy, or it's capital formation, where you want to raise capital to go do what you want to do with your business. You know, the process, the business sale process is one of what I would say is setting the plate, setting and putting the story together. Because at the end of the day, the investment banker's job is to maximize their client's value, right? And so how do we do that? Well, we do that by making sure, you know, you have financial preparation, your financials are in a good place, the modeling is done properly, you're telling a compelling story through your financials. You need to have your legal in order, you need to have, you know, clean ownership and cap stack for your companies, your tax filings are all in order, everything there is good. Operational stability is an important one. We keep saying, you know, predictive cash flow. I mean, everybody wants predictive cash flow. So, you know, you want to make sure that you don't have supplier concentration, that you have good relationships with your suppliers, that you have good growth prospects. Then valuation and deal structure is then you get into that, which is how much is your company actually worth. Now think about the work that you've done now, and we're now just starting to talk about valuation, and then we're starting to talk about deal structure, which is asset sale versus stock sale versus all that kind of stuff. And all that goes hand in hand with just trying to help you as a client understand what needs to be done. And then you start to get into putting the documents together and putting the data room together and and crafting the narrative around your business that is going to make it attractive to a potential acquirer or investor. And so, you know, what investment bankers really try to do is be your trusted advisor and give you really good advice on how to maximize your value as a business owner.
Thoughts, Danny?
Hire him before you start.
Danny, how do you think your financial background helps you with your clients at Aircraft Executives?
Well, I guess I know the game, so I understand the thought processes and, you know, from the leadership and the owner's perspective, as well as the processes and the stuff that behind the scenes. Clearly able to talk to the CFO on a, you know, generic accounting kind of basis with, you know, financial statements, balance sheets, understanding how this will impact them. But able to relate to them on a different manner, I guess, really helps.
So, Richard, tell me about the client you don't want.
Yeah, thank you for throwing that one at. You know, it really does come down to expectation, right? And so if somebody's got and let's think about this, a part of your planning too, and I failed to mention this, as a founder is you should be working with your wealth management folks on tax planning, because that has to happen before the deal is signed. After the deal is signed, that's too late. So you've got to be thinking about this yourself, right? What's the next phase of my life look like? What do I want to have out of this? Do I want to have enough to where I can go get on my boat and I'm done? Do I want to still be involved? Do I want to, you know, is this a transition to another step I want to take in a different place? So, you know, the client that really has unrealistic expectations sticks to them. You see it oftentimes in companies that are founder-owned, and the founder has done a remarkable job of taking the business where it is, but everything runs through the founder. Nothing gets done without the approval of the founder. The founder has the supplier relationships, he has the customer relationships, he runs that business on his own. If the founder is not willing to stick around, that's the value of the business, right? And I don't think anybody in this room would want to make an investment and watch that investment walk out the door a month after you've made that investment. So it really, you know, there are a myriad of things, but it's realistic expectations from the founder, and it's the founder having built a business that is sustainable on its own.
In that, Richard touched on a point that goes into the readiness bucket. So we talked about the attractiveness and the readiness, having to have both in order to be investor ready, is the buyer wants to know the owner's plan post-sale. So many deals with a single owner, a single founder, blow up at the 11th hour because the founder gets cold feet, right? Reality hits that person in the face, and their whole identity has been tied up in the business. And so the thought of, hey, I'm going to sell this and I'm going to play golf for the rest of my life is not realistic. If a founder has worked 50, 60, 70, 80 hours a week for the previous 20 years, 10, 20, 30 years, the thought of, hey, I'm going to have nothing to do and I'm going to enjoy it is actually a deal red flag. And that is highlighted. So in that planning process that Richard laid out and all the steps that go in it, you can see why we were laughing or smirking with each other about 6 months being ready to sell, is this plan of what am I going to do with the rest of my life? Am I going to start a new business? Am I going to run a nonprofit? What's entailed in there? And the more detailed you are, the better the buyer feels about the solidity of that deal. So that's actually a factor. We were also talking before about this concept of being not able to afford to sell the business. How could somebody not be able to afford to sell the business?
Well, I think we were talking about this earlier. Like, if the business generates, X amount of cash, and you haven't really saved anything as a founder, or you keep investing back into the business after all these years, to sell your business for a 5 multiple or 3 multiple what you would make in 3 to 5 years, that's not enough if you're A, not compete, or 2, retirement horizon is much longer than that.
Yeah, I agree. It's a math problem, right? You're generating very good cash flow and you're running a lot of stuff through your company and that sort of thing. It's a very good lifestyle business. And that's great. I applaud everybody that does that. But, depending on how your business is set up, the multiple that you might receive on the EBITDA that you're earning, the math doesn't work. And so then you've got to start having another conversation about, again, what do I want the ultimate goal to be?
Yeah, and just to jump on, emphasize that, there was mention, hey, it's very important to have an advisor on the sales side of the business, right? Just most people wouldn't buy or sell an aircraft without a quality broker. Same thing with your business. In addition, there's a whole parallel path that you need an advisor on, and Richard mentioned it's your wealth advisor. So being able to afford to sell the business also has to do with having an excellent financial plan for your future. So you're going down 2 tracks. You may have a business coach who focuses on execution, so your business is hitting your goals, but an overall plan being with a certified exit planner tied in with an investment banker, that's one track. The other track going down is making sure that you have an excellent financial plan, especially with family involved, right? All the stakeholders involved. And as you look at options of the business, there's this external, we've been talking about this investor ready, but what we see a lot in our industry, especially in the business aviation industry, is either there is a strategic buyer in place, so maybe not an investor looking for a specific return, but it's accretive to their own business or roll-up that they may be having, or it's internal, right? There's a lot of family businesses here, and whether you choose to exit through a third-party sale to an outside party or an inside party, those 2 factors of being attractive and ready still apply. That is what is going to allow you to leave a legacy. Because the option, if you're not attractive and you're not ready, when you get to the end of the line, the option is to shut things down. And that may be okay with some people too. But most people that I talk to, most of my clients that have been doing this 20, 30 years plus, they want this to live on beyond them. They've created something great. It's helpful to all the people that they touch, and they want that to live on. So being both attractive and ready helps you get there.
We have the ultimate question.
Ask it.
We always get right here in front.
Ah.
How do you value an aircraft brokerage firm when its value relies on the skills of the current salespeople? That's a bit of a dilemma. You've done it. I mean, how did you do it?
Well, in the brokerage firm, you hit on all of it. Like, it's very founder-led, family-led, and it's how do you get the systems and stuff in place where if you were to take us out of the business, what's the value for that for the investor? And more often than not, these businesses are lifestyle businesses, all guilty of it. But with proper planning and technique, if you have a goal of being there for when that strategic kind of buyer comes along, you could be a target for acquisition. But it's a very challenging one.
Yeah, it's tough. You see the same thing, commercial real estate brokerages, any kind of brokerage business, right? It's the people in their book. So you're basically buying the people in the book, so you'd have to figure out a way to probably tie that up.
Yeah, so if you own a brokerage now and you're thinking about this, what matters? Your brand matters. Your brand needs to stand alone. Like when your brand name is out there, that must evoke a specific message in the marketplace, or you're just a commodity, right? And then your customer experience needs to be consistent, and it needs to be repeatable. So independent of the dynamic owner or founder, almost every brokerage is founded by an extremely charismatic, dynamic salesperson, right? That process of the customer experience needs to be independent of that person, and you need to be able to prove that. So when you have a brand and you have a repeatable customer experience, at least you're on the track to say the company can survive without the founder or a couple of the key salespeople. But the reality is there's going to be some sort of, if there is a strategic buyer, and there will be strategic buyers for brokerages, especially if a roll-up is in play. I think realistically, there's going to be an earn-out that comes with it, right? They're going to want the investor or whoever the strategic buyer is going to want to see some sort of proof that this is going to sustain as we pull the owner back from the business. So, is there another question here?
Yeah, what percentage of the daily business time should leaders or owners expect to allocate when preparing a business for investment?
A whole lot. Well, I mean, as we were talking about earlier, if you set up, ahead of time and get it vetted, audited financials, get a data room together with, cap table projections or projections of, there's a lot of stuff that goes into it that there's people making full-time jobs that charging very nice fees to get this ready for you. But it's a lot because think about yourself as an investor. If you're going to invest in a company, you're going to want to get to know the CEO. You want to get to know this leadership team. You want to see the operations. You're going to want to know what you're investing in. And that takes a lot of time out of the people who are running the business. So, when you're ready for that stage, you should be having a leadership team, depth, that can run the business while the key leadership people are being constantly interviewed.
Yeah, I think I'd follow up with that and say, as business owners, you guys should always kind of be thinking about it. What do I want an exit to look like? It's not the premise of the business. You're not trying to run your business towards that, but there are things you can do for years leading up to an actual process happening and a sale taking place that can help mitigate quite a bit of that.
Yeah, the longer lead time you have, the more digestible that task is, eating that elephant one bite at a time. In the US world, we call that setting rocks. So on a 90-day, on a quarterly basis, you could have one rock per quarter that helps get your business ready for an investment. So, and then that's a very manageable task. But if you're in that 6-month time frame where it's all about getting ready, it is a ginormous resource suck. So Okay, I think we are over time here, so thank you very much for us. Oh, one more slide here. Let me throw it. If you want to, whoop, can I get it? There we go. If you want to know where your business is right now in terms of readiness and attractiveness, this is a free survey, and that will spit out an assessment for you on your readiness profile and your current business attractiveness. So thank you for your time. Enjoy Miami.
Thank you.